Good afternoon, everyone. Want to thank you for taking some time again on a Thursday afternoon, particularly with today being St. Patrick's Day, and more importantly to you bracketologists out there. The game's here starting right about now. I assure you we will try to make this short and sweet, but we've got a great call lined up with one of our mortgage brokers who's just done a tremendous job for us since he's come on board to the team. Chad Emerson with Prime Lending is with us. He's based out of San Antonio, but has done just a tremendous job. So before we start the call, I'd like to just encourage everyone to ask any questions that you might have regarding loans, the lending market, interest rates, appraisals, whatever comes to mind. In the lower corner where it says questions, you can submit them throughout the call. We will certainly field as many as we can. Try to make this a quick, informational call, and certainly appreciate your time. So, Chad, you there, pal?
Yes, sir.
All righty. Well, let's start with a little fun. I know you were sharing with me a horror story that you might have had on a loan that challenged you a little bit. Always like to ease the nerves and loosen everyone up a little bit. Can you share with the group one of the more challenging loans that you've encountered recently?
Oh, sure. This is actually for an owner-occupied property. It wasn't an investment one.
Okay.
Investment are usually more cut and dry, but I had a buddy of mine who's an agent. He inquired about helping out a buddy of his who was looking to purchase a house in an area here in San Antonio. It's called the Dominion. It's kind of where a lot of the San Antonio Spurs live and whatnot.
Okay.
But anyhow, he had run into an issue with a loan officer from a different company. I'm not sure if she was just new or didn't understand the system, but he was trying to buy this house, and he's self-employed, and he has about 7 or 8 businesses. And that was the issue with that was, as any self-employed borrower, as I'm sure you can attest to this, is you don't want to show everything you make, because if you claim everything you make, you don't make anything because you pay it back in self-employment tax.
Sure.
So, we had to dive in a little bit deeper with the income and try and find some income through the tax returns, which normally isn't a problem. But when I asked him to come in here with his tax returns, he comes in here with probably an 8x5 box. And I'm like, right away I'm thinking, oh, this isn't good. I'm in for it here. So he proceeded to open the box, and I thought he had brought maybe 10, 15 years worth of tax returns. He put 15 files down on my desk. They're all, all in a mess. It's all mismatched and a big rubber band around it. And I said, "What's this?" He's like, "That's 2009." I said, "Okay." And he's like, "I got 2008 here," so he takes that out, puts it on my desk. So like half my desk here is covered with these files, these manila files. Well, as it turns out, the guy's got he's got 8 businesses, but he files them as an LTD and an LLC, each one of them.
Wow.
Okay, so we're looking at about 32 files right at this point.
Oh my.
And we sifted through it, and we found some more income, a lot of depreciation, and the like. So that was the first part. We got through that just fine. It goes to underwriting, and then the last thing we had to do was verify funds to close. So he sends me in all his bank statements, which, we had to get some updated ones.
Okay.
The problem is on every single bank account, there's 3 names. There's him, his father, and his business partner. Okay? So they're trying to tell me that when you're using business bank accounts, and it's perfectly acceptable to use your business bank accounts as long as you get a letter from the CPA stating that he's not going to go bankrupt by withdrawing these funds.
Sure.
But the other problem is if there's other people on the bank statement and they're not on the loan, we can't use those funds.
Oof.
So suddenly all this money that he had, he no longer has. And to make a long story short, basically the underwriter worked with me, and she said, okay, have the business partners basically gift him the funds, which you can't do on it. You can do it on an FHA loan, which this one was.
Sure.
But we had to have them basically write the gift letters for each one of the people and the other 2 partners, and then take the checks directly to the title company so that we could close that day. So in the end, everything worked out, but it was probably about a 3-month process, and it was gratifying because it eventually closed, but it was a lot of stress, and I got a lot of gray hairs from it.
I'm sure at the end of the day, the underwriter probably didn't want to go through all the files either. So
Oh man,
they were probably trying to work with you more than they normally would, which is always a nice thing. So, well, that's
yeah,
good.
it took three files to make that one come to fruition. So that's all right.
Well, that's a challenging one, no question. What I would like to do is kind of start by setting the tone a little bit about the market. I know, obviously, it's been much publicized, the challenges that lenders and banks and everything has faced recently because they used to have much softer, requirements, and it was much easier to get a loan, obviously, 5-6 years ago. And now, we find ourselves in the current market that we're in because of that to a large part, and in turn the lenders have really regulated it considerably more, and now it seems like even the most qualifiable clients are having to jump through hoops and bounds to get qualified. What would you say, what's your kind of feel for the market in the next year, 2 years? Do you anticipate it continually getting more stringent, Chad, or do you think it's going to eventually soften up a little bit? Obviously, we were at an extreme probably 5-6 years ago. Do you think we'll ever be able to find that true happy medium?
I think so. I'm already starting to see some signs of loosening up.
Okay.
There's still more tightening going on, but in other aspects, there's some loosening too. One of the things that I'm starting to see as far as from a loosening standpoint, and take this for a grain, with a grain of salt.
Sure.
About 3 years ago, you'll remember that a lot of these investors could go out there and purchase a house which is 10% down, and
yeah,
you just get mortgage insurance for the, if you're over that 80%.
Mm-hmm.
And then pretty much, little by little, one mortgage insurance company and then another one would follow. And with mortgage insurance companies, monkey see, monkey do. One person drops it, everybody else follows suit. And before we knew it, all of a sudden, that was no more. You basically had to have 20% down, or because you just weren't going to get it. They won't insure investment properties.
Sure.
So probably for about 6 months after that, we still had that 10% down product, but it didn't mean anything. You couldn't find any mortgage insurance for it. Well, we recently had a representative from a mortgage insurance company come in, and they sent us their matrix, if you will. And I noticed on the matrix, I saw, hey, this says here you will allow up to 90% LTV for investment property.
Wow.
And she said, yeah, that's right. But then I told her, after we did a little more research, I was like, that's really awesome, but the problem is none of the investors will allow anything less than 20% down. So they've kind of flip-flopped now.
How about that?
But I think it's a positive sign, because it's, once investors start to become a little bit more relaxed, who knows? We may be able to start seeing some 10% down, some 15% down, with mortgage insurance. So it's out there, but we're not quite to that point yet. It'll probably be at least a year before we start to do that again, in my opinion.
Sure. And just to give the audience a quick backdrop of kind of what Chad's alluding to, currently, particularly in the state of Florida and mostly throughout the nation, the minimum requirement for down payment for an investment property is 20% down. The banks will only finance 80% of the purchase price. I believe there have been a couple products that have come and gone in certain states, but in Florida, over the past at least 2 to 3 years, the most financeable is 80% of the purchase price. So Chad's alluding to the hope that in the next couple of years there might be products that drop that down to 10 to 15% without having to pay an additional mortgage insurance premium.
Correct.
Which would be wonderful for us investors out there. Obviously, our goal is to leverage our current assets and spread out our funds to, seize the time to buy as many properties as we can in what's clearly defined as a buyer's market right now. So touching on minimum requirements, Chad, can you walk kind of our audience through credit requirements, cash reserves, debt-to-income ratio, some of the current requirements that are the minimum that are financeable right now for you? for an investment property?
You got it. Obviously, the bare minimum, first thing that any loan officer or even investor for that part is going to look at your credit score. You must have a minimum credit score of 660. And even at 660, the file may get scrutinized a little bit, but just so you know, that's the first requirement. Second would be you got to have your down payment, and it's got to be verifiable funds. Now, this is something that I've seen more and more of recently, too, and I just want to touch on this. You have to have 20% down on a single-family residence. But when I say you need to have you got to have the funds and the reserves, it's got to be your money. I have seen some people come to me and ask if they could have those funds gifted. But that is not allowed on investment property. Gift funds are allowed on conventional loans, but not investments. That's the first thing. On top of that, it depends on how many properties you own, but you also have to have reserves now too. Reserves are just as important. So if you've gotten past the credit score requirement, you've gotten past the down payment, you've got the funds, you also have to show that you have, per property financed, you have to have 2 months of principal, interest, taxes, and insurance as far as reserves. Now, that can be in the form of retirement. If you have maybe an IRA, 401k, something like that, as long as there's enough in there and you do have the ability to withdraw those funds, we can also use that if you don't have liquid cash, extra liquid cash in the bank.
Should you not be able to withdraw those? Let's say you're 45 as opposed to 59 and a half. When you could withdraw them without any penalty, is there a certain percentage that could be factored in as part of your reserves?
Yes. On the 401k, they will let you use really any retirement. They'll allow you to use 60% of the amount that's showing. So let's say you got a balance of $100,000 in your 401k. We'll be able to use 60% of that, and we could count that as reserves. Okay,
so that could be counted as reserves. And reserves are obviously not part of your down payment. It's just the bank wants to know that, should you lose your job or come under some difficult financing circumstances, you do have the funds to be able to pay your mortgage, correct?
Correct.
Okay. How about,
and then the other thing?
Go ahead.
The other thing too is there is a limit, and some may know this or some may not. But right now, you are allowed to have up to 4 properties financed at one time, and that does include your primary residence. So if you got a mortgage on your current house, you can have up to 3 more financed at one time. After that point, you can go up to 10. We do have the option. There's only one investor. They're called Fannie Mae, and we call it Fannie Mae Direct Program, where you can buy your fifth. You can have up to 5 through 10 properties financed at one time, but the criteria becomes a little bit more stringent, and that's the real difference. So credit score, instead of having needing to have a 660, now you have to have a 720 or higher. This is for 5 through 10 properties. The down payment's going to be 5% more. So on a single family, instead of 20% down, now you have to have 25% down. And then the reserve requirements are also much more stringent. You have to have 6 months PITI per property that you have financed in reserves.
That makes sense. I mean, obviously from a bank and a lender's stance, what they're trying to do is assess the risk. And the less risky the investment, the less they're going to require from the person who's the borrower. The more risky the investment, the more they're going to require. So, with each property that you accumulate, you become what's deemed as more risky to the bank because you have more that's leveraged, you have more debt, you have more going on. So that certainly makes sense. What Chad alluded to, and this is fantastic because not every lender and not every broker can go up to 10 properties. As he alluded to, only this Fannie Mae Direct program and the brokers that are in touch with it can actually assist clients receive a loan on their 5th, 6th, 7th, 8th, 9th, and 10th investment properties, and then everybody is capped out at 10 mortgages at the same time, correct?
That's correct.
Okay. So that is huge. That's fantastic. So, right now if you're an investor sitting on the sidelines and you only have, your primary residence, you in theory have the ability to get a loan for up to 9 homes right now, which is fantastic opportunity. Chad, I know one of the other requirements we didn't touch on was debt to income ratio. Can you kind of just explain exactly what that means and also, you know, the requirements, but more importantly, one of the really neat things that you can do that most brokers and lenders cannot is factor in the obviously the expected rent. So kind of walk everyone through that, if you will.
Yeah, yeah. Well, conventional financing has got a little bit more stringent on the DTI. I would say, when I say DTI, what we do is we're going to take your current gross income, and then we're also going to take your current debt. And when I'm talking about debt, we're talking about everything from vehicle loans to credit cards to even HOA fees on your current residence or another residence, property taxes, the PITI, everything. And we're going to divide that by your income.
Okay.
Now, you want to be at about 45% or less. Now, in some cases, if you're a strong borrower, in other words, what I mean by that is, let's say you have a lot of reserves, you got a really high credit score. In some cases, we can go up to 50%. But ideally, you want to be at about 45. And typically, most of my investors don't get up that high because we do have the ability, and Adam, I'm sure you could back me up on this, you know, as an investor, what's the main thing you're looking for? You're looking for a property that's going to cash flow.
Absolutely. And can produce.
Yeah, exactly. And you want to make sure that you're getting rental in that's going to more than cover just the mortgage, the PITI, everything. You want to make sure that you're also getting a little money on top of that. So what we're allowed to do with every appraisal that we order two different reports. One is an income and operating statement, and the other is a rent schedule. And what it does is it looks at what the current rents are in the area. It'll tell us what the going rent is for that type of property, and it's shown on the appraisal. And we are allowed to use 75% of that expected rent. So you do not have to have a lease, nor do you have to have a lease being transferred over to you. But we are assuming that you're going to have one because it is investment property, and we'll be able to use 75% of that number. And that really helps, especially if it's a good producing property. It more or less cancels out the mortgage payment that you're going to receive on it, even at 75%.
And this is huge for our investors. I mean, we've had a handful of investors that are very tight on their DTI, but because they're able to count, you know, that percentage of the rent towards their income, it almost completely nullifies the additional mortgage that's going to be added to their revolving debt. So this is a huge component that Chad and his group at Prime Lending has really benefited our investors. Chad, obviously, assuming that you can use expected rent, I'm sure that if an investor already has 2 or 3 cash flowing properties, you know, they certainly can use the rental income from those houses that are already rented out to offset those mortgages as well, correct?
Correct. And one thing we will look at is we're going to look at your tax return. So we want to make sure that you don't have like a $20,000 loss on that property. So we are going to look at the Schedule E. But typically you're paying taxes on whatever you claimed or didn't claim on those other properties. Now, if you did happen to just purchase these properties the year prior to doing your taxes, for example, I've got a lot of people that, they're procrastinating. They don't want to get their taxes done until the last second, April 15th, or
Sure.
Maybe they're going to file an extension. What they're going to do is, if they acquired the property in 2010, they haven't done their taxes yet, as long as they have a lease agreement to provide to us, again, we're going to use 75% of that lease agreement as well. So as you can see, it more or less, the ratios typically don't go up very much when you're purchasing a new investment property because, number one, you're using investment income, and number two, the new rent is going to, the rent on the appraisal that is going to more or less offset the entire payment for your new mortgage.
Sure, and that's huge. So for everyone out there, just a quick recap, the very bare bottom minimum is a 660 credit score, a 50% debt to income ratio, and we should say 49.9 if we're being very specific. Cash reserves of at least 2 months, principal, interest, taxes, and insurance for all leveraged properties.
Including HOA, too.
including HOA fees. That's a great point. So if you live in a community with HOA fees that you have to pay on a monthly basis, typically this is if you live in a condo community or a brand new development. A lot of times you'll find that. And then the other requirement is 20% down payment. So if the purchase price is $80,000, 20% down, $16,000 is required by the lender. The lender will finance up to 80% of the purchase price for you. So that's kind of the bare minimum. Obviously, as we talked about, the more and more properties you have, the more and more risky you're deemed to the bank, and the requirements certainly grow from there. So, Chad, talk to us a little bit about interest rates. One of the things that was certainly appealing last summer was rates, even for investment properties, were hovering in the high fours. Now it looks like they're climbing right around to 5.5 for a 20% down loan, 30-year fixed term. Most of our mortgages are 30 years. Some investors prefer to do a 15-year term, but let's talk for the 30-year term and a 20% down. Do you anticipate the rates climbing much higher? And obviously, I know that just in the past month they've gone up about 0.5%. Seems like now is the time to buy as opposed to waiting for that mythical bottom of the market. Would you agree?
Yes, I do. Of course, I see rates still going to eventually climb.
Okay.
But we're actually getting a little bit of help right now from two. It's kind of funny how not just our current situation here in the States, and when you're talking about when those rates were in the fours, that's just unheard of. I mean, that's just crazy. I mean, when I saw that, I couldn't believe it. But what it was is there's two things that are going to drive interest rates, and then there's going to be outside factors too. But those two internal things are, number one, what is the state of the U.S., let's use the United States, for example. What is our economy like?
Okay.
Now, when the market is not doing well, in other words, when the economy is struggling like we are, where we have high unemployment and we have a lot of people out of work, economy is struggling, we have a high, really high debt, what we're going to look at is not typically you want to spur growth. And the government's always trying to balance. You want to grow, but you don't want to grow too fast.
Sure.
Conversely, you don't want to fall too fast because then you go into what we're just climbing out of right now, which is the recession. But we're not out of the woods yet, but it looks like there's small signs out there that the economy is improving. Unemployment has dropped over the past couple months. At the beginning of the year, we're at over 9%. Now we're down to, I believe the most recent one was that I saw was 8.8%. I mean, it's starting to drop, so that means we're creating more jobs, which is good for the economy.
Sure.
It's also good for those 401k portfolios too. What
Absolutely.
it's not good for is mortgage rates, because now we have to worry when the economy starts to improve. You have to worry about inflation, and Big Ben Bernanke is getting exactly what he wanted. And he says it's easier to fight inflation than it is to fight out of a recession. We'll see if he's right. I mean, the jury's still out on that, but that's what he's going for. So we do have that. And when you start to see signs of an improving economy, rates are going to go up because they want to prevent inflation. They want to slow people from buying too fast and the economy growing too fast. But there's a couple factors that are affecting that. That being said, we've got tensions in the Middle East right now. You can't turn on the TV every day without seeing some sort of new uprising somewhere. And most recently it's been the Middle East, and we're seeing a couple things happen. Number one, oil prices are still extremely high, even though they dropped to, I believe it's $4 a barrel a couple days ago. But on top of that, anytime you have unrest in other countries, especially if they're oil-producing countries, that's going to have a big impact on stunting our growth here in the States. And when the economy isn't looking so good, what these investors on Wall Street, what they're going to do is they're going to sell off their stocks, and they're going to purchase more safe investments such as bonds, and part of that equation is mortgage-backed securities. Okay.
Sure.
But on the flip side of that, I'm going to go into a little bit of a microeconomics thing here, but what happened in Japan last week with the earthquake and the tsunami? And this is really fascinating to me that, stuff that's happening thousands of miles on the other side of the the world can actually affect our economy right here is there's a lot of insurance claims right now, as you can imagine.
Sure.
And a lot of the insurers in Japan primarily, they don't have enough money to meet the demand for all these claims. So they've got to come up with capital some way, and typically what these companies will do is they'll have to liquidate their portfolios of bonds and mortgage-backed securities. And as you know, it's no secret that other countries do invest in our bad debt here.
Sure.
Through the treasury auction. So what they're having to do is they're having to liquidate these, they're selling these, and anytime you increase supply out there, that's going to decrease demand because you've got all these bonds and all these mortgage-backed securities that are coming out of nowhere. They're out there now. They're available, and that makes investors skittish. And what they like to do is they're losing, that devalues their commodities, so they're going to sell off their stocks and bonds, and everybody's going to copy each other, especially the knee-jerkers out there. And then what you have is they got to put their money in something, so then they start to buy stocks and bonds, or they start to buy stocks, which is what they're doing today. Most recently, I think the Dow, let's see what the Dow is doing right now. I believe it was up over 100 points. And that's always a good way to gauge where rates are headed. Like today, the Dow is up 144 points, and the NASDAQ's up 35. So typically, however the stock market is doing, usually the antithesis of that is going to be how bonds and mortgage-backed securities are doing. When those aren't performing, rates are going up. And there's always going to be profit taking on Wall Street. So that's always going to be kind of a tug of war. It depends on what's being bought and what's being sold at the time. So the long answer to that is I think rates are going to stay pretty steady right now because you have those two forces right now that are combating each other, and neither situation is going to be over quickly. So I think at least for the next at least 4 weeks, hopefully, you know, my feeling is rates will stay pretty steady where they're at right now. They're in the 5.5 to 5.6% range right now for investors, with the 20% down on a 30-year loan.
That's good. So we've got at least a projected 4-week window to take advantage of kind of that push and pull you were referring to between the stock market and the bonds and mortgage-backed securities. So that's great insight right there. That's fantastic. What obviously you've been doing the business a long time. What's the highest you've seen the rates at from an investment stance?
It was about probably 3 years ago where rates were at one point, I remember they were 7.25%.
Okay.
And most often that was including one discount on top of that.
Wow.
Now, I personally don't like to charge discount points unless I actually have no choice.
Sure.
Discount points, really what they do is unless they're needed, they're really just going to be padding the pocketbooks of the loan officer. Okay.
Sure.
I feel that most of my clients, I get repeat business because I do right by them the first time. And I don't overcharge, and I'm not going to, you know, my rates are very competitive. I probably have some of the best rates, but my rates are very competitive right now. But at one point, I do remember that the standard was 7.25% and one discount point on top of one origination, and that was pretty much the standard for at least a year and a half. And then things started to get a little dicey and changed quite a bit, and I think a lot of investors recently have been reaping benefits. You know, historically, anything under 7% is an excellent rate, especially for an investor. But obviously, you know, we've been spoiled for so long. We've been in the 4s and the 5s, and that's just, it's outstanding. It's a good time to be an investor, that's for sure.
Absolutely, absolutely. I know you touched on discount points. We just got a question from one of our attendees asking about origination points on the loans that you're doing right now for an investor. Can you kind of walk everyone through the cost of origination points and maybe a little bit further on how you actually, you know, make your commission off of a deal and in turn the lender makes theirs?
Yeah, well, basically, I just want to clarify one thing. I am a mortgage banker with the ability to broker out.
Gotcha. Okay.
So just want everyone to understand that. But what I do at PrimeLending here, we charge 1% origination on everything, because that 1% is going to go to the company. Okay.
Okay. So
there's going to be standard. There's going to be standard costs out there. There's always going to be, an appraisal fee. There's going to be processing and underwriting. There's always going to be title fees. There's going to be prepaids, which what I mean by that is if you have an escrow account, all that. But typically, every single loan will have 1% origination. How I'm paid today is drastically going to change in about 2 weeks because used to be we would be paid on overage. And what that is, let's say that the bank will pay, let's say you want to send a loan to a different investor. Let's use Chase, for example.
Okay.
So I'm going to sell a loan. We're going to close the loan in-house. The whole process is done in-house here. But then eventually you need to sell that loan on the secondary market because we do have nearly $1 billion warehouse line. We've got lots of money. But we also have lots of clients. That money goes quick.
Sure.
And it doesn't take very long to spend $1 billion, let me tell you. So eventually what you have to do is you have to sell that loan on the secondary market to an investor so that you can free up money so that we can lend out more money. There's always going to be more people needing the funds.
Sure.
So anyways, well, let's say we've got a mark to go to Chase, for example, and they may say, okay, well, we're going to pay you 100.5 on this loan, okay? So we need to be at least at 100. So let's say that at 5.5%, they're going to pay 100.5. So that overage is 50% of that is going to be the loan officer's commission. 50% goes to the bank, 50% goes to the loan officer. The bank takes all the origination. So basically it's being on overage. Now, there's a bill out there that was passed, and I'm not too fond of it, but it's called the Frank-Dodd bill. And they said it's not fair to be paying loan officers and brokers alike commission on overage. So they are basically not allowing that anymore. So we had to come up with a different way to keep loan officers from, basically going broke.
Sure.
So now we're going to be paid based on our volume on a month-to-month basis. So we're less, again, this, I think in some ways this bill is a good thing because it encourages loan officers to not be so worried about how much overage they're making on the loan so that people are getting more of the same treatment. But on the same token, it's going to be helpful because you probably are going to see increased business.
Sure.
A lot more companies are going to be exiting the market. It's slowed down to quite some degree, but I think we're going to see a lot of brokerages go away too because of this. Because there aren't too many safeguards on how you're going to pay your brokers. If you can't pay them on overage, you've got to find another way to pay them. But fortunately, I don't have that issue here.
Sure. That's good insight. So things are going to change here sooner than later in the next couple of weeks. What percentage-wise, what would you say your typical closing costs per deal for an investment property are? Let's say you have a loan, $100,000 property with 20% down, so the loan amount is $80,000. What would an investor typically be looking at from a closing cost? And obviously, there's a little variance between title fees and prepayments and things of that nature. But
good question. I mean, there's no real set amount that I could think of, but I would tell you on a $100,000 loan, you're probably going to see your closing costs are probably going to run somewhere in the $3,300 range.
Okay. And
then you're also going to see prepaids, which everybody likes to lump these together, but I want to differentiate between those two.
Yep.
Closing costs are the fees that you're going to be paying the mortgage company, the title company, the appraiser, survey companies, all that's involved in every single transaction. And on top of that, though, you also, if you're going to have an escrow account, and I obviously try and encourage escrow accounts because it's just, eventually you got to pay the property taxes and the homeowner's insurance.
It's easier for everybody.
It's easier for everybody, but also a lot of the investors out there will, you can see a higher rate or you could see an additional cost to your loan if you don't do escrow.
Sure.
But because they like loans to be packaged with escrows. Now that's not to say that you can't have those removed once they get over to the new investor. And certainly there are some people out there that absolutely they just want to do their own escrow. So they're willing to pay a premium for that. And that's where maybe a discount point will come in. You can do one of two things. You can charge a quarter discount point and do your own escrow, or you can have a 0.25% added to your interest rate. Obviously, people choose the former rather than the latter because you're only paying for a one-time as opposed to over the life of the loan. But yeah, those prepaids that I was alluding to, you're typically going to have 3 months taxes, property taxes, and 3 months of homeowners insurance reserves. So when you add the two together, you're probably going to see somewhere in the neighborhood of about $5,000 on the $100,000 loan.
Okay. All right. So for investors out there, safely budget, between 5 and 6%, and you should be pretty much in the ballpark for sure.
And that is obviously a high estimate, and we like to, I want to tell most people that when we have a loan structured, before that appraisal even gets done, we send out a fees worksheet, and that fees worksheet breaks out for you. So it's all itemized. You know exactly what you can expect, and I give people a worst case estimate because typically, every single loan that I close, my fees are less at the table than they are what I disclose. And the reason for that is, I really have to do that. I would anyways because I don't like there to be any questions or concerns come to the closing table. But loan officers are being held to a higher standing. They want to really avoid people from being hit with a higher than expected amount of closing costs at the table. All too often that was happening in the past. Not with my loans, but in some other cases. So they've just said, okay, from now on, closing costs cannot be 10% higher than what the original amount was disclosed to the client. So your fees will always be less than and I try and tell people that have a concern when they see the closing costs, they're like, well, you've got down here X amount for this. Well, it's an overestimate. We'd like to leave a little room there because we're never going to let you overpay more than you're supposed to.
And I will support Chad in saying that he does a fantastic job of under-promising and over-delivering. I know this on the last HUD alone, I think we were about 25% below his estimate. So it's actually been something where in working with Chad, I've had to kind of prepare our investors that the GFE and the disclosure of fees are going to be a little bit higher than what they would expect, but to be reassured that we're preparing them for an absolute worst-case scenario, and we expect to be much lower. And Chad does a great job as well. He takes a lot of questions on the fee disclosure, and he wants that full transparency. He wants to make sure that our clients are very well taken care of, and they know exactly what fees to expect, and he walks them through each and every line item. So he does a great job. It's a great credit to him, and it's really tremendously beneficial for our clients, and it's why they've just had nothing but extraordinary words for Chad and the way he's handled himself. So it's a credit to you, pal. One other thing I wanted to touch on, I know we're running a little long today, but is appraisals. One of the most commonly discussed topics that we have are appraisal values. Are appraisers actually offering true value? Are they just justifying a loan? What are the risks to an appraisal company if they come in too high, if they come in too low? One of the things that, the trends that we've seen is most of the time recently appraisers are certainly just justifying the loan, and rarely do you see any equity whatsoever, and if you do, it's extremely marginal, even if the sold comp houses support much, much more listed on the appraisal. So I wanted to kind of get your thoughts, Chad, and obviously, being involved in the lending market, kind of walk us through the mindset of an appraiser and kind of what challenges they have on both ends from both the borrower and also the lender.
Absolutely. Well, oftentimes there's going to be, and I tell even not just my investors, but people buying their first home, or maybe they're buying an owner-occupied second home or what have you. I often tell them that, don't put too much weight into that appraisal. What a lender the reason why a lender wants an appraiser to go out there is they want to make sure that the tool that they're using, when we lend you money, we're using the house as the collateral, of course.
Sure.
So we want to make sure that when an appraiser goes out there, that the money that we're lending out to you is on something that is worth at least what that purchase price is. Okay. Now, but I tell them, I say, don't take that, if you get an appraisal on a house, don't assume that that's what you can turn around and sell your house for. Typically, you're going to get more money than what that appraisal is, because appraisals are given a copy of the contract. Okay. So let's say you got an investor buying a house for $100,000. Appraiser's going to get that contract. He's going to see, okay, this house is going for $100,000, so I need to go out there and make sure that this house is worth at least $100,000. And it's just human nature. I mean, are they going to put a lot of work into a house to get the very top dollar? No, really all they're doing on a purchase transaction, whether it be owner-occupied or investor, is they want to make sure that they're just going to at least hit the value that's on the contract. So I will say probably 90% of the time I get an appraisal back that's maybe 500 to 1,000 higher. And that's not 100% the case, but oftentimes I see very little equity on that. Everybody has their own reasoning for that. I think a lot of times that they do that to protect themselves from being blacklisted by mortgage companies. And I think Adam could probably touch on this a little better than I can, but typically a bank or a mortgage company there's going to be a lot of red flags thrown up. If somebody's buying a house for $100,000 and this thing is consistently, the appraisals are coming in 20, 30,000 high. Usually that's a good thing for the investor. Hey, great job. You've got instant equity. Everybody loves equity. That's why we buy homes. But it could throw up some red flags if values are consistently coming up higher. I mean, so to protect themselves and to keep the business coming in, I think oftentimes they will sort of temper their values. The other thing is it's human nature. I mean, if you only need to get $100,000, are you going to put all that work in there to see if you can get every single dollar out of every square inch and do all the investigation? Most appraisers probably will not. They've got a lot of business to do too. So as long as their values are coming in at where the purchase price is, then I think they're okay with that.
Absolutely.
What do you think, Adam?
I couldn't agree more. Just in the conversations that we have, obviously, every loan that we do from an investor stance, we have to have 2 appraisals on the property. So, at any given time, we're doing anywhere between about 15 and 20 appraisals a month. And quite candidly, we'll have conversations with a lot of the familiar faces. And I will definitely say that the majority of the appraisers are well aware of the fact that, they will lose business if they, A, invest too much time into the appraisal, and B, if they provide too much equity on the appraisal report. And it's unfortunately just kind of the way we operate, and it's something we have to prepare our investors for. It's very important that our investors realize that they are getting equity in this purchase regardless of what that appraisal report shows. And in fact, just to share a quick horror story maybe to kind of close on, we had a loan about 3 weeks ago that was declined by the lender because it wasn't through Chad, but it was declined by the lender because it showed too much equity on the appraisal. So the house we were selling to an investor for $93,000, which means after 20% down, the borrower would have been into the home for about $75 on the loan, $74, $75, and the house came back and was appraised for $141. So the borrower was obviously ecstatic. He knew what a great deal he was getting. It was a huge win. We thought internally that certainly there would be no risk of the loan getting declined because basically the bank was lending $74,000 on a house that was worth or deemed to be worth $140 plus, and unfortunately the lender just thought something was fishy and questioned the appraiser, and without really doing any more diligence decided to decline the loan. So needless to say, the next appraisal I had, I went to the appraiser and I begged for a exact purchase price appraisal just so that we didn't have that problem again. But it's a slight contradiction. It's one of those things that's challenging just in the respect, lenders are looking at risk. And, you would think that with more equity and a lower loan-to-value percentage, there would be drastically less risk in executing that loan. So, there are certainly some inconsistencies with the market and with the current relationship between lenders and appraisers. But at the end of the day, as long as our investors firmly believe that the equity is there and know deep down, and as long as the appraisers are justifying the loan, it really ends up being a win for all parties. So that's kind of the horror story, if you will, about appraisals. But I wanted to just wrap up and thank Chad very much for his time and his insight, and also more importantly, just his help as a truly valued teammate to us, our business, and particularly our inner circle of investors. If you have any questions, I know we were able to answer one or two from the crowd, but if you have any outside, please feel free to contact the office, and I will make sure to get you directly in touch with Chad, and look forward to it. As we talked about, the rates are going to be consistent for the next couple weeks, it sounds like, so now is a great time. If you have interest in setting up a strategy session and determining whether or not you're a good fit to invest with us, please feel free to give us a call. The office line is 904-677-6777, and check us out on the web at jacksonvillewealthbuilders.com. But thank you to Chad, and thank you to everyone for taking some time out today. We certainly appreciate it.
Thank you.